In this video, we'll talk about two key factors to help you manage risk in your retirement portfolio. Knowing the difference can save you a lot of money. So, in this video, we're going to talk about two things that we've heard of and introduce them in a little different way in comparison. And we want to ask the question, which factor is most effective for accurately monitoring the risk in your retirement portfolio? Is it something we're all familiar with, average annual returns? Or is it something I like to call the Wobble Factor, better known as standard deviation? How far the pendulum swings back and forth as markets move. Because the question is, don't we all want to sleep well at night, or what I refer to over the years as swan, in our retirement? So let's take a look at this chart, and we're going to show you two portfolios. Both start with $1 million. These portfolios, these people are retired. They both need money to live on now, so they're going to both begin pulling $50,000 a year, or 5%, which is a little rich in this environment, out of these portfolios. The one on the left-hand side is the good old S&P 500 index fund. We can invest in it anywhere you'd like. And here are the returns. This chart goes back from the year 2000 out to 2017. Doesn't matter the years, the numbers work out pretty much the same. You'll see that over on the other side of the coin is a tactically managed smart portfolio. A portfolio where the risk is being monitored and checked on a monthly basis to help stave off big wild swings in our pendulum. What's unique is both portfolios have the identical average annual return after these 17 years of 6.91%. So one would think if we have $2 million portfolios pulling $50,000 a year out, both earning 6.91% average annual return, they should be equal after this period of time. Well, let's bring the other factor into the equation, the Wobble Factor, or standard deviation. Our S&P 500 portfolio, you'll see that we end up after these 17 years with $348,382 left over. Not bad. But you'll see down on the bottom left hand of that column, the standard deviation for this portfolio, how far the pendulum swings, is 17.92%. Let's go over to the other portfolio, our tactically managed smart portfolio. Same identical return. However, how much money do we have left here after the 17 years? $1.576 million. And what is the difference? The Wobble Factor. The standard deviation of the smart portfolio is 6.82% a year versus the 17.92% a year in the other side. So, average annual return, certainly nice to have. But if we're trying to manage risk in retirement, and that is what we are trying to do, then pay attention to the Wobble Factor is so much more important than how much you return. Having more money to live on, I'm certain is something you'd like to have. You want to learn more about how to manage risk in your retirement? Keep watching our videos, subscribe, and also click on the calendar link below that you can schedule a time to discuss this with me.